2023 in the stock market. Welcome on into today's video. We're going to be talking about all these right here and how absolutely horrible forecasters are and analysts are at predicting the reality or the end target on where the stock market is going to be. So we're looking at right now is a look at Wall Street, bunch of firms on the left-hand side, their 2022 outlook right here. I'm going to have 2023 covered up, and we're going to cover that here in just a second. But what is hilarious is that as you look back through this outlook, you'll have the green highlighted as the highest forecast, the red as the lowest forecast. And what we see here is that Morgan Stanley had the lowest and closest forecast to where we actually finished on the S&P 500 at the end of 2022. But essentially here, guys, no one came close. The max target was 5,200, a little over that by Deutsche Bank. We have the minimum 4,400, but where the average and median, which actually lined up pretty close together, they fell at 4,900. So let's take a look at the S&P. Let me go change this over to the dark mode really quick. And what we're going to see is that the S&P ended up finishing the year down in here, actually just north of 3,800. So the median and the average target was actually all the way up here. All the way up here. Now, they didn't think we're going to have a great year in terms of, upside. I didn't think it would be like that much. We pretty much finished last year like right around here. So they were essentially forecasting us to have a 2% year in the S&P, 2.5% on average. Yet we ended up with a year that was more like down 20% instead of up 2. Now, let's talk about 2023. I think this is going to hit on the bias in the market. And before we uncover this, the biggest bias that we saw was that things were good and they were expected to stay good. Now, of course, there was the threat for rates, and that at that point in time, we pretty much knew like we were headed down that road of rate hikes to come from the Fed. Inflation being transitory, we were going to find out very shortly after that it was not transitory. But it wasn't like we didn't see an increase in rates coming. That was known. The extent was more so the question, and so it makes sense why we saw a lot more downside as the market had to then price in, oh, well, now the unknowns of becoming more known of, oh, wait, now we're going to actually raise rates a lot more, right? But as we go into the year 2023, I think it's interesting to note this. Of course, I'm not going to sit here and say, oh, these guys suck and I'm so much better, because who the fuck am I? Right? Who the fuck am I? But what I think is important to look at is you're going to see this stuff on CNBC. You're going to see forecasts by people on social media. You're going to see people who want to put out the forecast. And to be honest with you guys, at least in terms of where I come from now, where I feel now, it's chasing clicks, it's chasing views, it's chasing attention, because people and for good reason, because people want it. Don't get me wrong. People want this stuff. Like, people want someone to tell them where they think things are going to go. Does it matter? Probably not, right? And there are a million opinions, but people crave this stuff, right? So it makes sense from a psychology perspective, right? Like that this stuff does well and that this is, put out every year, right? But as we go into this year, what is the overwhelming bias right now? Fed, higher for longer, more hikes. They're going to be higher, and they're going to hold them higher. We're towards the end of the hiking cycle, right? They're not going to hike that much more in terms of how many more basis points are we going to go, right? There's probably a couple hikes to go, maybe one, maybe two, maybe a 50, maybe a 25, maybe two 25s, maybe dare we say 325s. Could it go more? Yeah, sure. But like we're probably somewhere on that road, right? After a bunch of 75s, like we've gotten the bulk of this out the way. The reality now is that's where we're sitting. So the two camps of upside, downside, right? For what we're about to reveal to play out, we have to kind of go along with what the market's expecting. And what we're expecting right now is weakness initially, followed by some sort of bounce back, right? That's what we're kind of expecting. And we're followed by rates eventually pausing and then maybe some cuts late year. The Fed says they're not going to do maybe some cuts late year, and maybe the market can actually bounce back in a situation or in a circumstance where we see cuts late year. So here we go. Let's reveal them. Right now, Barclays is coming in with the lowest forecast for the S&P, which, by the way, 37.25 on the S&P 500 from we're filming this video right now. That puts you down right here. So after whatever happens this year, they're not expecting much. Now, it could go down, up, whatever, but they're expecting us to come down a little bit from where we are right now. Let's go out further. Deutsche Bank, still the most bullish on the street, and maybe they will be right if what we have happen is the opposite of last year, and the concerns of higher for longer going in terms of being in last year, right? We're kind of like not expecting as many hikes. But if we start this year with the expectation of, oh, we're going to stay higher for longer in terms of rates, but we end up staying higher for shorter, or we actually don't have that extra 25 basis point hike because of the data that comes out in the coming months to start the year, and there's only like another 25 hike on there, and there's not 2 or 3 hikes, and maybe the second half of the year, summer, fall, they start talking cuts, and maybe there's a cut, maybe there's 2 cuts late year to finish off 2023. Again, there's so much that can happen and so much data that has to come out that can easily move this stuff, right? Then maybe Deutsche Bank is actually closer to being the winners here, and they're not the ones that are the farthest off. So that's essentially kind of talking about both sides. Of course, then there's the recession case. We go into a deeper, darker recession for longer, and that could send us down, dare we say, deflation, and that could get us down towards Barclays, or dare we say lower. But it seems like from a stock market perspective, I've seen many charts from Morgan Stanley, JP Morgan, in terms of their expectations of what we're going to see. And if we kind of get rid of some of these lines and we kind of talk about the expectations of this year, and we zoom these charts out, expectations right now seem to be along these lines. Something like this, followed by, something along these lines to finish off the year. And actually, it seems like we might even get higher. And of course, don't worry about the time scale there. I did draw this out a little further into 2024, but let's pretend that this is 2023, okay? This is where we set our eyes. The max target is 4,500. The min is 37.25, okay? The average and the median are just around 4,000. So that would put us on the S&P 500. That would actually put us like right in here, okay, across SPY, or the S&P 500. SPY around 400, S&P around 4,000, roughly what we're talking about. So yes, my drawing is nasty, but that's what we'd be looking at. So the expectation is that we have a dip early, followed by some choppiness and some slow grinding back, potentially smoothed out on an average scale up towards 4,000. That's the expectation. But I think the biggest takeaway from this, number one, these guys actually suck. And number two, that's fine. It doesn't actually matter. But number three, if we are aware of the base case, as this year starts to play out, we can start to back our way into the reality. And if, again, we aren't higher for longer, okay, and we're not higher for longer, but for maybe better reasons than the bear recession, horrible deflation case, and we kind of can ease our way in, and I don't want to say the word soft landing bull crap, but whatever, get soft landing that, generally gets the point across. If we end up in some sort of situation like that, then maybe we talk about a higher target to the end of the year. And then obviously on the flip side, if we do stay higher for longer, or let's say inflation picks its head back up, or we have horrible earnings and earnings are terrible and it's like recession and we're going down and the Fed over tightening, and then that becomes very, very clear, then we can certainly see the opposite. We can see the downside targets or the lower end of the spectrum hit. But I thought this was interesting to know, at least at a minimum. And I'm curious to hear your thoughts in the comment section down below on this type of stuff, because this stuff gets tossed around a lot, right, this time of year. But we can kind of see that as much as everybody is like, oh, it's obvious, don't fight the Fed. I saw it coming. How did you not know? Well, the biggest dogs on Wall Street apparently didn't know what was coming this year, apparently. So hope that makes some sense. Any links, resources will link up down below. We do go live Monday, Wednesday, Friday, so make sure you are subscribed, thumbs up button. Also Sunday nights, we do a stream every Sunday night to kind of get us set up for the upcoming week. And I hope to see you guys in a future video. Peace out.